Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one actively managed member of our list of 72 favourite funds, namely Kames Ethical Cautious Managed. The investment objective of fund managers Ian Buckle and Audrey Ryan is to provide a combination of income and long-term capital growth. The fund invests in a wide range of UK equities, bonds and cash, which meet the fund's predefined ethical criteria. Equities, stocks and shares, well, they'll be limited to a maximum of 60% of the fund's value at all times, and as we can see from this first graphic, 58% of the 581 million fund's assets are currently held in shares, with 39% in bonds and around 3% in cash. As I sit here, the fund's got 74 shareholdings and owns 131 bonds. 9 of the top 10 individual positions are stocks, and the 5 biggest are shares in life insurance giant Prudential, academic publisher RELX, Vodafone, Sage and Ferguson. The biggest bond positions include debt issued by Network Rail, Transport for London and Deutsche Bahn, the German railways operator. By equity sector, the biggest exposures are financials, industrials and consumer services, while there's relatively limited exposure to utilities, healthcare and oil and gas. This chart shows how the 58% equity allocation is built up. The numbers therefore are up to 58, not 100. In terms of the fixed income exposure, this next graphic shows the bond quality breakdown, where the vast bulk is investment grade or BBB- and above. Again, the bond numbers add up to 39%, that's the allocation, not 100%. The fund offers a yield of 1.9%, which is paid quarterly, although in this case we're talking about the fund's accumulation units, so those dividends and coupons will be automatically reinvested for you. The fund is eligible for SIPPs, ISAs and dealing accounts, and the minimum investment is just the 1 share. The ongoing charge figure is 0.75%, so you do have to pay for the expertise of the fund managers, and for those who set store by such things, the fund comes with a 4-star ranking from Morningstar. So, those are the mechanics. The question to address next is, why could investors consider this fund for portfolio inclusion today? Well, I think there may be 3 possible reasons. The first is the ethical nature of the portfolio, which may appeal to certain investors. The fund is managed to strict ethical criteria, which does have a significant impact on the underlying investable universe. However, the managers, backed by the well-resourced wider equity and fixed income teams at Kames Capital and a dedicated environmental, social and governance team, will have all proven themselves pretty proficient at interpreting the views of the wider group while still delivering long-term performance within the constraints of the mandate. The second reason to look at this fund right now is the cautious nature of the portfolio perhaps. Share indices are trading at pretty much all-time highs in the UK, and government and corporate bond indices have also done well. So those investors who are getting a little bit nervous but want to keep money out of the bank and in the markets may find a mix of bonds, stocks and cash relatively appealing. The third is the UK focus of the fund. UK equities have underperformed on the global stage for a couple of years. They don't look expensive relative to their history and come with a decent yield. In addition, UK government bonds have yet to sell off like their American counterparts, not least as the Bank of England is raising interest rates more slowly than the US Federal Reserve and seems in no rush to follow its American equivalent in unwinding quantitative easing. Now, throw in the fund's own solid performance record since launch in 2013, shown here, and you can argue that there's a lot to like. However, this is not to say that Kames Ethical Cautious Managed will suit every investor, also for 3 reasons. First, some may not care for the ethical tag and fear that they may be missing out on sectors which can provide strong capital returns or income, such as oil and gas, tobacco or defence, for example. This is all in the end a matter of personal taste. Second, investors might fight shy of the fixed income exposure in the view that the combination of lowly yields and inflation that already stands at 3% and a Bank of England that's already raised interest rates once may mean that bonds represent return-free risk. If inflation sticks at 3%, then the real value of coupons could be eroded. And if interest rates go higher more quickly than thought, then bond prices could fall, inflicting losses that may offset the benefit of the coupons. Third, some investors may want wider geographic exposure and to go beyond the narrow confines of the UK because they fear political risk. They're concerned about Brexit, think the pound is going lower, the economy could perform poorly, any one of those. If you share any or all of those views, then a UK-oriented fund may not be for you. What this does go to show is that investors must therefore do their research on Kames' ethical cautious manage to make sure that it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.